Hello everyone, welcome. Today we're going to evaluate a rental property. We're going to answer one simple question. Does this deal make financial sense? Let's look at today's case study. We're evaluating a newly constructed duplex located in Palm Bay, Florida. So there are two identical units. Each of them have 4 bedrooms and 2 bathrooms. The asking price is $600,000. The estimated gross rental income is $4,600 per month for both units. So the question is, would you buy it? So when you're figuring out if you want to invest in a rental property, you have to ignore the beautiful finishes, the landscapings, the marketing photos, and dig deep into the numbers to see if they make sense financially. The first screening tool that most investors use when determining if they want to invest in a rental property is the 1% rule. The rule says that the monthly rent should be approximately 1% of the purchase price. In our featured property, the purchase price is $600,000, and 1% of that would be $6,000. However, we're seeing that the projected rent that is expected from these property from both units will be $4,600. So does it pass the first test? Then no, the answer is no, it doesn't. The property only produces about 0.77% of the purchase price each month. Therefore, it does not meet the 1% rule. That does not automatically make it a bad investment. It simply means that you need to investigate a little bit further. So we will use the second test. The second test is a 50% rule. The rule assumes that approximately half of the rental income will go towards operating expenses. That's a very clear cut. So we're saying that we're expecting that the rental income is going to be about $4,600. So the 50% rule will automatically assume that $2,300 will be used towards operating expenses, including the insurance, including property management, utilities. Does not include any kind of mortgage debt, no mortgage expense. This is only operating expenses. Now let's see what a mortgage would look like. When it comes to financing, we're going to assume that we'll put 20% down and take a 30-year mortgage. Now the current market interest rate is about 630, 650, so we'll say about 650. The estimated monthly mortgage payment is approximately $2,955 a month. Now, if we were using the 50% rule, this is where we would say, okay, we're assuming half of the monthly rent revenue is $2,300, and we're adding the mortgage expense. We're looking at $5,255, which is way over what we are expected to receive in rental revenue. You would have a negative cash flow. So that shows that financing matters. A property that looks acceptable before you put the debt, once you put your mortgage debt and how much your monthly mortgage expense is going to be, then it's looking completely different. So in this case, since we know this property and we know where it's located, we can actually estimate some of the expenses and not use the 50% rule. So not using the 50% rule, we're going to use exactly what we think the estimated expenses would be. So gross rent will be $4,600. We would put 5% of this to cover any vacancy. So anytime that the property is sitting without a tenant, that would be the vacancy, and we are going to account for this by putting 5% of what our income should be to cover any kind of time that we have no tenant. We're going to estimate the operating expenses with property taxes being $395 per month, homeowners insurance at $392 per month, and any kind of maintenance and repair. Bear in mind, this is a new construction, so there's not really a whole lot of maintenance and repairs that are expected, but we will put anyway an extra 5% to cover any kind of maintenance issues. So we were going to assume that operating expense is about $1,017. So instead of using the 5% rule, the 50% rule here, and use $2,300, We are going to use what we think is the estimated expenses for this particular property, which is about $1,017 per month. Using this, we'll put down that we have a gross rental income of $4,600 minus the vacancy allowance of $230 minus the operating expense of $1,017 minus the mortgage debt payment of $2,955. This gives us a net monthly profit of $398 and an annual profit, of course you multiply this by 12, of $4,776. So you notice this when we use the estimated expenses for this particular property, it produces a cash flow, a positive cash flow, as opposed to if we use the 50%. So this is why experienced investors don't stop after the first screening test or the second screening test. So let's continue and use our third test. Let's answer this important question. So is your money working for you? So to figure out if your money is working for you, you're gonna calculate the return on investment. That means that if you had a certain amount of money in the bank and you use it, you leave it in the bank will give you interest. So you want to make sure that you invest in a property that will give you more interest than if you had left it in the bank. So is the money working for you? Let's calculate the return on investment, the ROI, by using the formula of the ROI, which is the down payment of $120,000, the closing costs, estimated closing cost of $24,000, and that will give you a cash invested total of $144,000. To calculate the ROI, you do the annual profit of $4,776 divided by the $144,000 of initial cash investment. That gives you an ROI of 3.32%. So that's almost like if you had your money in the bank and you're getting interest of 3.32%. When calculating whether an investment is a good investment, you have to consider your return on investment, your tax benefits, and all of the other advantages, including equity, building of equity on the property. So is it a good investment? The answer to this will depend on what your investment goal is. If you want immediate cash flow, maybe not. Maybe there are better opportunities if you want immediate monthly cash flow. But if you want long-term appreciation, then maybe that's a good investment because you build an equity. Yeah, it's a new construction, so you don't have to spend a lot of money in maintenance. You can get steady tenants. Palm Bay is an area that's growing, so a lot of new residents are coming in, so you will most likely get steady tenants who have who are gainfully employed, who are gonna rent your property. So now other strategies that can be used if you don't want to rent out your property, you can do house hacking. So you live on one side and you rent the other. So that way you reduce your rental housing expenses, and you're building equity on the property. Short-term rentals. Airbnb is still a lucrative business model, so it's good to check and see what the regulations are in the area. And so whatever your decision would be when evaluating a rental property, you should never buy a rental property because it's beautiful, but you want to purchase a property because the numbers make sense. Do not buy a rental property or investment property based on emotions. To make sure that you make the best decisions, you have to go by the numbers, calculate, make sure that the numbers make sense before you invest in a rental property. So do not forget to use the 3 tests, the 1% rule, the 50% rule, and the return on investment. Well, thank you for watching. Now you should be able to confidently evaluate a rental property. If you ever have any questions or need assistance in determining if a rental property is a good deal, if it's worth investing, feel free to call me or send me a message. My information is on the slide and I'll be glad to assist you. Until next time.
this world.